Welcome to the Performance Monitor for March 2017. My name is Barney Hawkins and I've joined True Potential as Investment Director. Today I'll review how markets have performed during February and then look at some of the key issues globally. Looking at returns, we've seen positive figures from virtually all asset classes. The US has led the way with continued positivity around Donald Trump and his planned reforms in America. After the last few months of negative performance from fixed income stocks, bond markets have rallied, offering returns of around 2.4% for UK investors. On the currency markets, sterling has weakened against the US dollar, which has been a benefit for UK-based investors holding dollar-denominated overseas assets. In America, Donald Trump continues to dominate financial headlines. For some, his forthright, America First protectionist approach threatens the delicate balance of global trade. For others, particularly the financial markets, his promise to reduce taxes, impose border tariffs, repatriate offshore manufacturing, and invest in infrastructure projects represents a clear commitment to revitalizing the US economy. The consensus view among our manager partners is that these messages will put upward pressure on inflation, leading the dollar to strengthen and economic growth to improve. But interest rates at current levels look increasingly inappropriate for such expansionary policies, and the US Federal Reserve has hinted at a further tightening of monetary policy with 2 or 3 further hikes in interest rates forecast during the year. Whether Trump's initiatives will serve to extend the current economic cycle remains a moot point among our managers. But markets appear happy to back him in what, financially speaking anyway, has been one of the most optimistic starts to a new presidency. Over the last month, the Dow Jones Index has hit a new high of over 21,000, up 4.8% over the month, with the wider S&P 500 index up 3.7%. The UK has followed suit, with the FTSE 100 up 3.1%, touching a new high of 7302, and the broader FTSE 250 index of mid-cap companies up 3.4% in February. Turning now to the bond markets, one side effect of the economic optimism surrounding the initial days of the Trump presidency has been the greater likelihood of inflation. For policymakers in the US and also here in the UK, this presents a conundrum. Do they begin raising interest rates to more normal levels and risk derailing the recovery, or do they leave policy unchanged and risk having to take more dramatic action later should inflation begin to get out of hand? The general perception is that interest rates are likely to rise before long, but that the rise will be modest, and after a difficult January, bond markets rallied, with UK bonds up 2.4% over the month and global bonds up 1.9% for a UK-based investor. So, looking ahead, there are, as ever, conflicting signals, and some investors are conscious of the US and UK markets touching new highs. However, our objective when building portfolios is to listen carefully to what our manager partners are telling us and to balance the potential risks with the need to seek rewards. Increasingly, our managers are looking towards alternative investments to counter elevated valuations in the equity markets, as well as to find additional sources of sustainable income away from the bond markets. The critical element in all of this is to remain diversified across all asset classes and to invest for the long term. The last 9 years of exasperatingly low interest rates should have provided a salutary lesson for investors who worry short term but have savings needs that stretch out over the much longer term.